So I want to read you something David Bateman wrote. He's a billionaire. Here are the reasons I invested close to $1 billion in precious metals over the past 6 months, including the purchase of 1.5% of the annual global silver supply, 12.69 million ounces. Here are his reasons. The global monetary system is about to collapse, the Great Reset or Basel Endgame, he mentions. The biggest credit bubble in history will soon pop, 300 trillion. There is no way the U.S. can refinance its 28 trillion in maturing treasuries in the next 4 years without an obscene amount of printing. Trump tariffs are hastening the collapse, and it's by design. Now, I've talked about that a lot lately, that I wonder, could it be by design to lose the reserve status? Interesting, he says it. Gold and silver are the only meaningful life raft. Physical possession is everything. The whole world right now is a sophisticated game of musical chairs. The chairs are precious metals. He says crypto is a psyop. Those who purchase will have no chair when the music stops. Real estate, crypto, stocks, and bonds will all lose significantly compared to precious metals. The banking system has been meticulously designed to seize your assets to buoy a collapsing banking sector. See the great taking. You have zero counterparty risk with precious metals in your own possession. I'm up 20% already on most of my purchases. This is not a drill.
The silver market is flashing major distress signals. Despite years of manipulation via paper futures, physical silver prices are beginning to decouple from COMEX benchmarks. Lease rates are soaring, some reaching 8%, and platinum rates recently surged to an eye-watering 18%. This signals extreme tightness in supply and growing demand for immediate physical delivery. At the same time, short positions on silver have hit historic levels, with commercial traders now facing nearly $1 billion in paper losses. The dislocation is real, investors are scrambling, and what once looked like routine volatility is now beginning to feel like a structural failure in the silver market. London's LBMA, the world's largest silver trading hub, is nearly out of freely available silver. Inventories have dropped to just 155 million ounces, the lowest level ever recorded. Shockingly, that's less than a single day's trading volume in London's paper-silver market. David Jensen points out that nearly 2 billion ounces are traded daily, 10 times the available float. The LBMA's shift from T+1 to T+8 week settlements reveals growing logistical failures and possibly concealed shortages. Combined with skyrocketing exchange for physical EFP rates, this indicates massive stress in the bullion infrastructure. The cracks are visible. The world's silver backbone is under strain.
It seems to me that the silver market and maybe the platinum market are under stress. And if you look at that chart that Ed Steer provided you way back when that we've talked about the short positions, silver and platinum are the number 1 and 2 most shorted commodities on the COMEX market. And it seems like, and again, I don't want to get too excited because we've been through this so many times, the little boy who cried wolf, we always know that the wolf does come, but it seems like the paper futures market prices are kind of disconnecting from the physical prices after all of these years. And what you're seeing really are traders rushing to secure physical metal, possibly to avoid, risk if physical shortages worsen. First of all, obviously, this is a very bullish environment for metals and could trigger more volatility. But in general, what we're seeing in silver is different than anything I've ever seen in this marketplace. So you have a guy named Daniel Gali of TD Securities, where he argues that the outflow of silver caused by the tariff arbitrage, and I don't think it's just a tariff arbitrage, that's what they want us to believe, has left inventories of freely available silver critically low. In fact, the LBMA, the London Bullion Metals Association, silver free float now stands at the lowest level in recorded history. So this is the most influential silver market on the planet, the LBMA, and it's at its lowest level of silver holdings ever. We've talked about this, done again ad nauseum, the drawdown in silver off of the exchanges, and he writes, the so-called free float of inventory at the LBMA has dropped to just 155 million ounces. That's less than a single day's worth of trading volume for spot silver in London, and it makes an unprecedented squeeze in the world's most important silver trading hub. The result is a dramatic spike in the cost of borrowing silver with 1 month Lease rates soaring as high as 8%, and a level almost never seen in this market. If you have to pay 8% to lease the silver in order to cover a position, you're in big trouble. And, David Jensen, who does a masterful job of talking about what goes on in the LBMA, says that they're actually trading about 1.9 billion, with a B, ounces per day, 3.5 times annual global mine supply, and in this case, well over 10 times the float every single day. Now, he says that they trade roughly about 190, 200 million ounces or somewhere in that neighborhood, but those numbers are 10 times understated as they only post the final settlement number. So when you're trading, in essence, pretty dang close to 2 billion ounces a day, and you only have 155 million ounces backing it, what could possibly go wrong? And that's the situation where LBMA has gone from T+1 to T+8 weeks, citing a shortage of manpower and trucks. Couple other things we're talking about. The last week's COT report, or this week's COT, Commitment Traders report, just came out on Tuesday. And it's interesting. It shows that the commercial banks have 79,600 contracts net short. That's about 404 million ounces. The interesting thing is that they built this short position at or around $37.50 when they dumped a whole bunch of silver short. But now silver's over 39 bucks. These traders are freaking out, and they're bleeding hard. That shows let's see here, a silver about 2.5 bucks higher. That would be a paper price loss of pretty dang well near $1 billion in 3 days. So not only has the silver price hit its highest mark since 2011, the banks have just set a new record for the largest short position ever in the history of the COMEX market, ever. And they're underwater $1 billion in 3 days. Now, the silver EFP, which is the exchange for physical, surged by 250% in the last couple of days. What does that mean? That means that it's the cost to swap physical silver for futures has skyrocketed by 250%. This increase would signal massive stress in the silver market. It means that traders are scrambling to find any silver they can, which is in short supply on that level. And this is a major move that would typically only reflect massive tightness in the physical market or a lack of trust. And that's a scary thing. So you have skyrocketing lease rates. Lease rates are between 6 and 8%, very high. And by the way, platinum lease rates just popped up to 18%. That's extremely high. It says extreme tightness and extreme demand for physical to metal. You also have the gold EFP rates that just jumped up $4.50 just yesterday. That's another sign of dislocation and demand for physical delivery. So when you got gold and silver and platinum lease rates blowing up, you have the exchange for physical rate blowing up, you have the T+1 going to T+8 blowing, or 8 weeks blowing up, and on and on and on. This is a sign that we hadn't begun to see where this market ultimately goes. And you have these big traders that are heavily short and expecting prices to fall, but the market goes the other way. It's a scary thing. And at the same time, you have all these premiums jumping. This has to have the banks rattled. A couple other things that I noticed over the weekend. David Bateman, are you familiar with who that is, Dunnigan?
I haven't followed him.
He's a billionaire, and I want to read something to you because I think it underscores some big money, right? So we've talked about that since the beginning of the year. The insiders, the institutions, the institutional traders have been selling equities every single week. Since June, they've been averaging about $2 billion a week selling. At the same time, ma and pa retail investors have the largest allocation ever to equities. It's even greater than the dot-com bubble. So what could possibly go wrong there? The insiders, the Buffett sitting on the sidelines with $500 billion, the selling by Jamie Dimon and Bezos and Zucker, they're all selling, and the institutionals are selling at a 6-to-1 clip to buying on the insiders since the beginning of the year. 6 sales, 1 buy by the insiders who know the trajectory of their business. None of that's good. At the same time, you have on the COMEX level and the LBMA level, which reeks of sophistication and inside info and money, they're ripping metal off the exchange at a level that's never been seen before, the lowest level of silver ever in the history of the LBMA, and the largest deliveries ever off the COMEX. Not a good thing. That's done by institutional traders. On our level, me and you, we see most of the retail public has no idea what a gold or silver coin is. So you look at the dichotomy. The insiders are selling equities and buying commodities and standing for delivery, while the retail public has nothing in the way of commodities and is all-time record in equities. What could possibly go wrong? Okay.
While retail investors remain fixated on stocks, institutional insiders are quietly dumping equities and loading up on physical metals. Billionaire David Bateman recently revealed a $1 billion investment into precious metals, including 12.7 million ounces of silver, 1.5% of global annual supply. His reasoning is sobering. Impending monetary collapse, an unpayable $300 trillion global debt load, and engineered economic stress via policy such as Trump-era tariffs. The banking system, he warns, may be preparing to seize client assets in the next crisis. Meanwhile, insiders are taking delivery from COMEX and LBMA at record levels, confirming that the smart money is leaving paper behind. Across the board, signals are flashing red. COMEX commercial banks hold their largest ever short position, while spot silver breaks decade-long highs. Gold and platinum EFP rates are surging. Trucking delays and personnel shortages are blamed for delayed settlements, but insiders suspect deeper issues. Billionaires are sounding the alarm, saying this isn't a drill. They're speaking plainly. Fiat is losing credibility, and physical metals are the ultimate safe haven. This isn't just a market event, it may be a tectonic shift in global finance. As the music nears its end, only those holding real assets will still have a chair when the game stops.
So I want to read you something David Bateman wrote. He's a billionaire. Here are the reasons I invested close to $1 billion in precious metals over the past 6 months, including the purchase of 1.5% of the annual global silver supply, 12.69 million ounces. Here are his reasons. The global monetary system is about to collapse, the Great Reset or Basel Endgame, he mentions. The biggest credit bubble in history will soon pop, $300 trillion. There is no way the U.S. can refinance its $28 trillion in maturing treasuries in the next 4 years without an obscene amount of printing. Trump tariffs are hastening the collapse, and it's by design. Now, I've talked about that a lot lately, that I wonder, could it be by design to lose the reserve status? Interesting, he says it. Gold and silver are the only meaningful life raft. Physical possession is everything. The whole world right now is a sophisticated game of musical chairs. The chairs are precious metals. He says crypto is a psyop. Those who purchase will have no chair when the music stops. Real estate, crypto, stocks, and bonds will all lose significantly compared to precious metals. The banking system has been meticulously designed to seize your assets to buoy a collapsing banking sector. See the great taking. You have zero counterparty risk with precious metals in your own possession. I'm up 20% already on most of my purchases. This is not a drill. Your grandkids someday will either muse or lament this financial decision you're now faced with. Don't fail them. And that's coming from David Bateman, a billionaire who just spent $1 billion on precious metals. So I want people to understand that this is a change. And everything he said is what you and I have talked about, almost verbatim. Not always in that sequence, but we've talked about all of that. And the biggest thing to take away from it is he is recognizing that the biggest money in the world views the counterparty risk as legit. So he's buying it, he's standing for delivery, and he's saying the things that other people at his level don't really say, but you can see by their actions. Selling equities, accumulating physical, de-risking. He's saying it. The others are doing it and not saying it. And I give him a lot of credit and respect. Love to get him on our show and talk to him, but doubt that will happen. But at least on Twitter anyway, he wrote the reasons why he put nearly $1 billion into precious metals. And I think the same thing is true when you see these deliveries at the level of sophistication it takes to deliver off COMEX or LBMA. You're talking the biggest money in the world, the most tied-in money in the world, the most sophisticated money in the world, the most well-informed money in the world. as he said, your grandkids don't fail them. I would say that that's legit. I do. I think that's legit if things play out the way I think they will, ultimately, the way he thinks they will. And that's what we're seeing at the highest levels right now.